All right, so you wake up in the morning, the market starts to sell. Okay, then this is around 6 a.m. Okay, around 6 a.m. Then you wait for the trend to be broken. So when it's broken, you buy. After one or two spikes, you buy because it's broken. So and this boom, so it will be spiking. Then you set your TP in between the first point where the day started and began to trend downward, which is this horizontal line, and your buy position. You set a TP in between that. You divide it into two and you set your TP here. Then from here, the market begins to move. The market begins to move upward, and you wait for a time where the trend is broken, is clearly broken. So you see at this point that the trend is slightly broken, it's slightly broken here. Okay, so from here, when you see it's slightly broken, you can actually come and sell. But you shouldn't sell for too long because we are not so sure that it's completely broken. So you have to wait. Even though you sell here, you have to sell for a short distance. Okay, because there's no clear why are you selling for a short distance? Because there's no clear indication that the market or the market trend has been completely broken. Okay, so you keep watching the market till it goes up, and then there's a sell again. Let's say you might not even join the sell. Now it goes up because we are always spotting the points at which we are very sure that the trend has been broken. Even though you can come into sell at points where there's a slight break, you cannot be too sure until you spot a point where this is a clear indication that the trend has been broken. Then you come in and then you sell. So how do we know at this point? How do we know that a trend is broken? We see it here. We see a movement here. Okay, we see the trend. Yes, so we see it broken here. This is where we see it broken. This is the breaking point. Once it breaks, we are confident that even if it spikes and we are in losses, it's going to come back down. So at this point, you can sell, and you realize that if you sell between this slightly broken point, okay, this zone, within this zone, and then where you entered, you can place your TP halfway. But the reason why I wouldn't place TP halfway, but I'll rather extend it, is because there's been a very long trend of spikes, which means that the market is going to retrace. It's probably going to retrace by about 50%. So I would enter here and I'll set my TP somewhere here. So let me put it TP. I'll set my TP somewhere here. Why? Because there's been a long series of spikes. So I know that once the market breaks and it's going to reverse, that is going to go down much more than when I come in at this point, because there's no clear indication that the market has broken. It's just a slight break. Okay, so let me go to the first market. I think when I was talking about it, I didn't realize my sound wasn't working. Let me just refresh your memory. So we started from point A. That's where the day began, and then we saw a downward trend. So we come in quickly, we place our point A here and our point B there. Okay, then we wait for a particular point we are sure the trend has been broken. That's what I keep repeating. Let's always be sure that a particular trend has been broken, because if you're not sure, the trend will also reverse again and you'll be in a loss. So from A to B, we see a downward trend and we see the market picking up, but at this point we see that it has broken. How are we sure? Because I spoke about the loss of momentum, which I mentioned in one of my videos. The title is How to Know When the Market is Turning Around. you see that there's a loss in momentum. So we have a small candle, we have a large candle, we have a larger one or almost the same size, then we have the largest one. So after the largest one, you see this candle shows up, this red candle shows up. I'm talking about the red candles. This candle is smaller than this, which means that the rate at which the spikes are occurring on the crash market has reduced. There's a loss in momentum on the spikes. And then we see an even smaller spike here. So once we see that this red spike is smaller than this one, it means that the market has lost momentum. So when I see a green candle after the small red candle, I'll come in and buy. Do you see that? And when I buy, I was saying that there are two TP points we can place. The first TP point is between A and B. The gap between A and B, halfway between A and B, can be our first TP point. So we buy here, we set our TP here. Or we buy here, gauge the middle, and divide the middle and the buying point into two and set our TP here. So there are two things. Either you set your TP here, which is the halfway point of A and B, or you set your TP here, which is halfway between your buying point and your TP1. Okay, right. So the market goes up. After taking your TP, the market will go up. Don't enter yet. You have to wait. Now when you wait for a while, you see that the market turns back, goes up, and turns again. Then you come in with your trend line and draw a diagonal resistance line, and you see that the market is going down. So as it's going down, you come in and drop your D at the point where a green candle indicates a change in trend. You drop your D here. Then you see that point AB is parallel to point CD. So the next time we are going to buy is when our charts or our candles break that parallel line, that parallel ABCD line, and is moving out of that channel. So you realize that ABCD has formed a new channel, a downward channel. So this gap here is a downward channel. That gap is a downward channel. Then you see a break in the channel. When the channel is broken, you can come and buy. And when you buy, between C and buy point, you can set your TP, which is here. That's halfway C and buy is your TP. So you TP and then you relax. You keep watching the market. So if you relax and you keep watching the market, you see that there's a downward trend again. Now if I zoom out, you'd see that AB is parallel to CD, and we have another line this way. Although this line is not parallel to CD like this, it is still showing us that there is a downward movement. It's still showing us there's a downward movement. So you have to wait for that downward movement to indicate that it's going to change in trend. Then you come in here after you see that there's a rise or there's a break in momentum. You see there's a small candle and there's a large one. So there's a break in momentum here. Then you buy on the green candle. Do you see that? And you set your TP between point D and then your buy. You break point D and your buy point here into two, and you set your TP there. So from here, you know that if you are a high risk taker, you can even set your TP somewhere here, because you know that the market is going to buy for a long time after a long downward trend from A to the buy point. But just to be safe, you can set your TP between D and buy, halfway between D and buy, and you are good to go. Right, so do you have any questions? Let me know if you have questions. Okay, so if you don't have any questions, that will be it for today. The dollar is awake. As you can see, the charts are still reading. Now, do your own practice on your demo. Try to analyze the market by yourself from what you've learned from today's video and the previous video. That's the part 1 of dollar is awake, and see how well you understand the market. Okay.